Everyone, and welcome to our session and today's lecture on preparation of financial statement. I'm Salma Siddique and we'll move from high-level concept to hands-on preparation technique using a concise work example to tie everything together. By the end, you should feel confident explaining the four core statements, describing the regulatory framework, and outlining the practical workflow for producing them. Let me begin with a simple analogy. Running a business without financial statement is like sailing without a compass. You might be moving, but you won't know where you're headed or whether you're safe. Financial statement tell us the story of a business, how it's performing, where its money is coming from, and where it's going. So first, let's level set. A financial statement is a formal record of a business activities. Think of it as the organization medical chart. Income, expenses, asset, liabilities, equity, all measured at clearly defined date or period. Why does it matter? Because without a trustworthy chart, neither managers nor outsiders can diagnose performance or prescribe strategy. The purpose of financial statement is to communicate financial performance and position to stakeholders. They tell a clear, standardized story to owners, lenders, and regulators, aid in decision-making, financial planning, and compliance. They feed budgeting, forecasting, and compliance process. If you take nothing else away, remember clarity and comparability are the currency of financial reporting. The users of financial statement. We have users in two criteria, internal and external user. Internal users, managers and employees who optimize operations, external investors, creditors, tax authorities, even potential acquirers. Each group reads with a slightly different lens. Profitability, solvency, tax compliance, but they trust the same underlying data. So we have four types of financial statement, or also you can say the big four statement. Everything else in today's lecture ladder up to these four. Income statement, which shows profitability. Balance sheet is the snapshot of a financial position. It shows asset, liabilities, and equity. Cash flow statement, which shows liquidity story. Statement of changes in equity, how owners' stake involves. Income statement. It reports revenue expenses. So, for example, if we take revenue of $100,000 and expense of $70,000, $100,000 subtract $70,000 is $30,000. Note especially the reporting that start with gross revenue, subtract cost of goods sold to find gross profit, then deduct operating, financing, and tax expenses. As for balance sheet, as I said before, it's the snapshot of financial position. It shows the organization selfie on the reporting date. Asset on the left, current, then non-current, liabilities and equity on the right. The golden rule is asset equals to liability plus equity. They must balance. If it doesn't, something is miscategorized or missing. Asset is $150,000. Liabilities is $50,000 and equity is $100,000. Since asset is equals to liabilities plus equity, if we take $100,000 and $50,000 of liability, we get $150,000. So asset and liabilities plus equity balances. Now cash flow tells us how money moved, not just that it moved. We bucket flows into operating, investing, and financing. Positive operating cash with negative investing, growth capex, and moderate financing flows often signals a healthy expanding firm. So for example, is operating cash flow is $20,000, investing is $5,000, and financing is $20,000. Cash flow statement is categorized in three categories, which is operating, investing, and financing activities. Now for statement of changes in equity. Finally, equity changes start with opening balance and net income. Then we subtract dividend and adjust or share the issue or buyback. It basically shows the changes in equity components like share capital and retained earning. The example is net income is added, dividend is deducted from retained earning. Now for the regulatory framework. Financial reporting doesn't happen in a vacuum. It is circumscribed by law, stock exchange rule, and professional standard. In Bangladesh, listed entities must align with IFRS as adopted by ICAB, supplemented by BSEC guideline. So this financial reporting is governed by regulations. They include national standards, stock exchange rules, and international standards. As per GAAP, in the US, the GAAP is widely followed, and it is codified by the FASB, Financial Accounting Standard Board. And its strength is its consistency, and its limitation is its jurisdiction. It ensures consistency, reliability, comparability in financial reporting. So IFRS is issued by the IASB, which aims for comparability across 140 plus countries. Please note that there's a difference from GAAP. It includes the treatment of inventory such as FIFO, LIFO, and development cost. So for the preparation of income statement, it summarizes the revenue and expenses for the period. Result is net profit or loss. Now for the preparation of balance sheet is the roll forward opening balance in corporate asset purchase, disposal, depreciation, new borrowing, and tax settlement. It basically is a list of asset, liability, and equity. It classifies into two categories for asset and liability, which is current and non-current. And as I said before, cash flow statement is categorized in three segments, and there's two type of cash flow. One is indirect, another is direct. Indirect starts with net income, adjusts for non-cash item and working capital, and direct lists cash receipt and payment. Indirect is more common because the reconciliation to profit is explicit. It basically shows the movement of cash under operating, investing, and financing. And for the preparation of statement of changes in equity, we start with opening equity, we add net income and subtract dividend. We show other equity changes, which is issue of shares. If you take close look into equity from last period, there will be a difference. So we'll dive into this more in depth in next few slides. So first, I give an example here. The following transaction occurred for ABC company, where the sales revenue is $100,000, cost of goods sold is $60,000, operating expense is $15, depreciation is $5,000, interest expense is $2,000, income tax is $3,000, new equipment purchase is $20,000, share issuance is $10,000. Dividend paid is $5,000, and there is an increase in account receivable, which is $2,000, an increase in account payable, which is $1,000, a net income of $20,000, and return in earning in the beginning of the year is $15,000. Additional paid in capital in the beginning of the year is $5,000. So we will prepare the income statement, balance sheet, statement of changes in equity, and statement of cash flows. So for the income statement, as I said before, first we take the revenue and we subtract the cost of goods sold, we get gross profit. Then we subtract the operating expense, which is $15,000. Then we subtract depreciation, and then we get operating income of $20,000. And then we add other income, which is $5,000, and then we get $25,000. And our earning before interest and tax is $25,000. Then we subtract the interest expense, which is $2,000, and then we get earning before tax, which is $23,000. And then we subtract income tax expense, which is $3,000, and then we get a net income of $20,000. So as per of statement of changes in equity, we take the opening balance of paid in capital, which is $5,000, and retained earning $15,000, and we get share issuance of 10,000. And from net income statement, we got net income of $20,000. And from the example, we got dividend paid of $5,000. So we do that and we get a closing balance of share capital $10,000, additional paid in capital $5,000, and returned earning $30,000. Total statement of changes in equity is $45,000. Now for the balance sheet, as we said, asset is in the right, and then we add liability and equity. So we have asset of property, plant and equipment, which is the non-current asset of $30,000, and current asset, which is cash and account receivable, which is $14,000, $2,000. So we get a total asset of $46,000. And as per for liabilities and equity, we get account payable of $1,000, which is our liability, current liability, and then we get equity of share capital, additional paid in capital, and retained earning. And the total equity is $45,000. Total liability and equity is $46,000. We get a total asset, and total liability and equity has to match. So the total asset is $46,000 and the liability and equity is $46,000. So they balances. Now for this statement of cash flow statement, we are doing the indirect method. So we take net income of $20,000 and depreciation of $5,000, and then we get increase in account receivable from the example, which is minus $2,000. And then we get increase in account payable of $1,000. So we get our operating activities, which is $24,000. And then we take purchase of equipment, which we get a net cash from investing activities. Then we take share issuance, dividend paid, and then we get net cash from financing activities. So we add and subtract them and we get a net increase in cash of 9,000. And then we add the beginning of the cash, which we had in the example, which is 5,000. So our ending balance of the statement of cash flow statement is $14,000. So do note that we provide additional detail and context in the financial statement. There is always a note segment where we have to put additional details regarding anything that takes place. It might be even called disclosure. So there's numbers that rarely speak for themselves. It can be regarding accounting policies, significant judgments, and contingency. They convert raw figure into an intelligible narrative. Now the management prepares and the auditors verify, and there are a lot of type of report. It could be an unqualified opinion, which enhances credibility. A qualified or adverse opinion can raise capital market and alarm bell. So there are a lot of type of report. So one is unqualified, second is qualified, and the third is adverse report. Now the technology in preparation of financial statement. Software from QuickBook to SAP now helps to automate journal entry, generate draft statement, and flag anomalies. Your roles shift from data entry to data stewardship. Basically, this software helps you to prepare a financial statement automatically as you record the data. So it helps with accuracy and speed. So misstated reports distort everything from share price to supplier relationship. The cost of error scales exponentially with size and delay. Timely report ensures relevant decision making. So the role of an accountant is to ensure the guardian of financial truth, which means preparer, analyst, and ethical gatekeeper, which master both the technical standard and the storytelling. So to wrap up, the four core statements interlock to portray performance, position, cash, and ownership. Preparation demands technical rigor, regulatory awareness, and an eye of narrative. So these are the vital tools for stakeholders, the core financial four statements, and it shows the proper reflection of the true picture of a business. So I would like to wrap up my lecture. So if you have any queries, you can write it in the comment section, and if you liked my lecture, you can give a like. Thank you very much. With this, I want to end my lecture.